All right, today we're putting on our detective hats because we've got a real financial mystery on our hands. We're going to piece together clues from all over the place: stocks, crypto, bonds, even gold. Now, on their own, they might not seem like much, but when you put them together, well, they tell a pretty unsettling story about a massive hidden tension building just under the surface. So let's get into it. If you just glance at the markets right now, everything seems pretty calm, right? Kind of stable. But as any good detective knows, sometimes the quietest scenes hide the biggest secrets. We're going to investigate whether this calm is for real, or if it's more like that eerie silence you get right before a big storm hits.
So, our investigation starts with the most obvious place, the US stock market. We're looking at the S&P 500. This is our first clue.
For weeks now, the market's been, well, kind of stuck. It's just been moving sideways in this really tight corridor, as you can see here. Now, it did recently bounce off a key support level, which, on the surface, looks like a good sign of strength. But let's dig a little deeper into what that level actually is. That support line was the 100-day moving average. Just think of it as a sort of center of gravity for the price over the last 100 days. And yeah, the price bouncing off it is technically a good thing. It suggests buyers are stepping in. But this is pretty much where the good news stops and our mystery really starts to deepen. So what if this quiet period isn't stability at all? What if it's actually a trap? This is where a really troubling pattern from the past comes into play, and it's something that should make any investor take a step back. Okay, just look at this. It's kind of spooky, right? On the left, you've got the S&P 500 right now, and on the right, that's Bitcoin's chart from late 2021, just before it crashed by over 50%. See the similarity? Both have this long, boring, sideways period after a huge run-up. Analysts have a name for this. It's called distribution. Basically, it's the smart money, the big investors, quietly selling their shares to everyday folks who think the flat price means everything's safe. And what makes this comparison even more worrying is that Bitcoin itself, which a lot of people see as the canary in the coal mine for risk, is already looking weak. It's broken below a key level, which suggests the riskiest assets are already flashing warning signs. So clue number one, this calm is probably an illusion. All right, let's move on to our next clue. This one takes us away from the flashy stock market and deep into the very foundation of the global financial system, government bonds. One analyst, Albert Edwards, called what's happening a tectonic shift. And honestly, that's not an exaggeration. Something really fundamental is breaking in what's supposed to be the safest part of the market. Okay, super quick refresher on how bonds work because it's important for the next part. Price and yield are like a seesaw. When investors get scared and rush to buy safe government bonds, all that demand pushes the price up. And when the price goes up, the yield, or the interest rate, goes down. Got it? Good. And this is the core of the problem. Check this out. The world's two most important government bond markets are literally moving in opposite directions. In the US, yields are falling. That means investors are scared, and they're running to the safety of US bonds. But at the exact same time, in Japan, yields are rising. That means investors are selling their bonds and running away. These two massive forces are pulling the system in opposite directions, and that can't last forever without something snapping. So where is all this nervous money going? Well, it seems to be running to the oldest, most time-tested, safe haven there is: gold. It's like gold has sensed this trouble and is moving up. Meanwhile, Bitcoin, its so-called digital counterpart, is struggling. When there's real fear in the system, it looks like capital is choosing that old, boring metal over the new tech. And that brings us perfectly to our third clue, which is all about Bitcoin. Because while it looks weak on the surface, what's happening underneath is way more complicated. It's like a witness in our investigation that's telling two different stories at once. So what's the deal here? Is the price chart telling the truth, that Bitcoin is fragile and about to drop? Or is there some hidden force coiling up, getting ready to explode upwards with incredible power? The data is pointing in two totally different directions. So let's break down this paradox. The bearish case is everything you see on the surface. The price chart looks kind of weak, there's low liquidity, which just means it's easy for big players to push the price around, and a ton of recent buyers are holding at a loss, which creates selling pressure. But, and this is a huge but, under the hood, the bullish case is explosive. There is a record amount of stablecoins. Think of them as digital cash, just sitting on exchanges. That's what we call dry powder, and it's ready to buy. In fact, the ratio of Bitcoin to this dry powder is at a historic low, a setup that in the past has come right before huge moves to the upside. So the crypto market right now is the perfect picture of a compressed spring. It looks weak and dead on the surface, but underneath you have this unprecedented amount of buying power just sitting there, waiting for any kind of spark. It's an extremely tense, unstable situation. So far, all our clues, the weirdly calm stock market, the broken bond market, the coiled crypto market, they're all things we can see in public. But for our final clue, our final reveal, we have to go behind the curtain to find what might be the real source of all this tension. And here it is, $2.5 trillion. That's the value of illiquid, meaning hard-to-sell assets being held by U.S. life insurance companies. Yeah, the very institutions that are supposed to be the bedrock of financial safety are sitting on a mountain of stuff they can't sell quickly in a crisis. And let's put that number into perspective. That $2.5 trillion makes up 37%, over a third, of everything these insurers hold. We're talking about things like private loans, commercial real estate, stuff you can't just unload with the click of a button. And here's the really alarming part. That share is even higher than it was right before the 2008 financial crisis. And here's the final twist. Not only are these companies holding more risky, hard-to-sell assets, but their own safety cushion, the capital they have set aside to absorb losses, is at a 20-year low. So you've got more risk and less protection. It's just a dangerous combination simmering behind the scenes. So our whole investigation brings us to this one final chilling question. All the clues we've uncovered, the tension in stocks, the weirdness in bonds, the paradox in crypto, they might just be the cracks we can see appearing on the surface. But what happens to the whole system when the hidden fire that's been smoldering in the foundation, that $2.5 trillion problem, finally breaks out into the open? If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next daily edge. There's more news in our Telegram channel. You'll find it in the first comment. See you next time.